All right, welcome to The Explainer. Today we're diving into the latest NETRA report, and we're going to get behind the big splashy headlines. We want to see what the numbers really tell us about some of the biggest stories shaking up finance right now.
You know the headlines, you see them everywhere. Chatter about skyrocketing U.S. debt, a fiscal cliff, some kind of looming crisis. It's just this constant drumbeat of anxiety. And honestly, it's enough to make any investor pretty nervous.
But, as we always do here, we've got to ask, does the data actually back up the panic? Or is there maybe a more interesting story happening just beneath the surface? Okay, let's take a look.
Let's start with a number that might surprise you. 246%. What is that? Well, it's the total U.S. debt. We're talking government, households, businesses, the whole shebang, measured against the size of the economy. Here's the kicker. Before the pandemic, that number was 252%. So total leverage has actually fallen. Yeah, let that sink in for a second.
So that brings us to our first section, what I'm calling the U.S. debt surprise, where we're going to take apart that common story and see why it just doesn't paint the full picture.
The story you hear on repeat is simple, and let's be honest, it's scary. The entire U.S. economy is just leveraging up at a totally insane, unsustainable pace. It's a picture of a country basically drowning in red ink.
Okay, so let's rewind the clock to January 2020. This is right before, well, before everything changed. Federal debt was high, no doubt about it. But just kind of file away those other numbers for households and corporations.
Now let's fast forward to today. And boom, this right here is where the story completely flips on its head. Yeah, of course, federal debt went up, but look at literally everything else. Households, corporations, even state and local governments, they've all deleveraged. Their slice of the debt pie has actually gotten smaller.
So here's the key takeaway. This wasn't some kind of across-the-board debt party. Not at all. It was a massive rebalancing act. The federal government basically stepped in and took on debt precisely so that families and businesses could get their own finances in order. This is kind of the exact opposite of the story we usually hear.
So what does this all mean? Well, it means the U.S. economy as a whole is probably sitting on a much stronger, much more robust balance sheet than most people realize. And, this really challenges that popular demise of the dollar story. It suggests that King Dollar might just be a lot stronger than the headlines want you to believe.
Okay, next up, let's jump from the U.S. over to one of the world's most watched emerging markets, India. And what's fascinating here is that the data tells two totally different competing stories. It really just depends on your time frame.
First, let's do the zoom out view. When you pull the camera way, way back and look at India's long-term economic path, the picture is just incredibly powerful, really optimistic. Think about this. Back in 1980, India was just 3% of the world's economy. Today, it's about 9%. But just look at that projection for 2050. If these trends keep up, India and China together are on a path to become a third of the entire global economy. I mean, that is a truly monumental shift in economic power. Okay, but that's the big picture, 30,000-foot view. What happens when you zoom right in and look at the data from just the last few months? Well, a very different, much more cautious story starts to emerge. Just look at these recent trends. Personal loan growth, it's been cut in half. Passenger car sales have hit the brakes. Industrial output, tax collections, they're also growing in a much weaker pace. The data really suggests that the big post-COVID boom is cooling off, and cooling off pretty significantly. And this contrast, between the long-term dream and the short-term reality, it brings us to a really critical question. With this kind of data, are the markets maybe running on fumes? So let's take a look at valuations. You hear a lot of talk that the worst is behind us, that we're at the start of a brand new bull market. But after such a long run-up, you have to wonder, right? Does the data really support another huge leg up, or have our expectations maybe gotten a little ahead of reality? Now, this chart is absolutely fascinating. It breaks down companies by their valuation, their PE ratio. And you can see it right away. There is a huge cluster of companies trading at really expensive valuations, over 40 times their earnings. In fact, there's still about twice as many expensive companies as there are cheap ones. So, if you're a bargain hunter, where do you even look? Well, this slide makes it pretty clear. It is tough out there. Real, genuine bargains are getting pretty scarce. You can see they're really concentrated in just a couple of spots, like financials and IT. But in contrast, a sector like capital goods, which was a huge leader in the bull run, looks almost completely picked over. Very little margin of safety left.
Okay, so if the data is flashing all these caution signs, why are markets staying so expensive? Well, the answer, I think, lies in a classic economic trap, what we can call the rational investor's trap.
You might have heard of this idea, the tragedy of the commons. Well, this is the market version of it. It's basically a situation where a whole bunch of smart people, all making what they believe are perfectly rational choices for themselves, end up collectively creating a really fragile, overvalued market that's bad for everyone. Let me show you how it works. So think about it from just one investor's point of view. The logic is actually pretty hard to argue with. If I add a little more risk and the market keeps going up, I get pretty much all of that reward myself. The downside, that the whole market gets a tiny bit more fragile, that's a cost that's shared by millions of other people. So my personal gain feels huge, and my tiny share of the cost feels, well, tiny. The rational choice seems to be keep buying. And what happens when every single rational person follows that exact same logic? You create a feedback loop. It locks everyone into a system that just keeps pushing the market higher and higher, even when the fundamentals underneath, like company earnings, are very much limited. This is how bubbles get built.
So here's the crucial point. Looking at the data is one thing. That's vital. But understanding the collective psychology that can drive a market to just ignore that data, that's something else entirely. The numbers might be telling a story of caution, but human psychology often pushes us in the exact opposite direction. And trying to navigate that conflict, well, that's the ultimate challenge for any investor. Thanks for watching.